Tell me a story that illustrates bad tokenomics.
So the Chinese government was like, no, we got to shut this down because it's competing with, the yuan. We're moving to a world slowly and painfully, moving to a world where tokens are token and blockchains are a technology, and they're wrapping or representing hard assets that do have fundamental values.
Hello, everyone, and welcome back to the Bitcoin Economy Podcast. Today's guest is someone who has quietly shaped the way the entire industry thinks. His name is Matty, known online as Matty Tokenomics, and he's become one of the most respected voices in token design. In this conversation, we get into the stories, the good designs, the bad designs, and the models that actually work. We explore the psychological side of tokens, the mistakes that keep happening, and what the future of sustainable crypto looks like. So I had a lot of fun in this conversation, and I really hope you do too. Please enjoy this wide-ranging podcast with Matty Tokenomics. All right. Tell me a story that illustrates bad tokenomics.
Oh man, where to begin? There's so many cases of bad tokenomics. I think, my favorites are the ones that are, or my quote unquote favorites are the ones that just only think about the supply side and don't really think about demand at all. And so, there was a project. Perhaps your listeners are Bitcoin ecosystem oriented. So in the Stacks ecosystem, there was famously a project that was launching where the tokenomics just made no sense at all. They ostensibly were like tokenizing real estate, but they layered in so much complexity to kind of confuse people about what the token actually did, and it didn't actually track the value of real estate in any way. It was all these like Ponzi-Nomic yields. So it was all about supply emissions that actually drove the yield. So those kind of cases like drive me nuts, right? Because I think people have finally learned it, but in DeFi summer, people didn't realize or think about how the higher the APY, all else equal, the higher the rate of inflation, because that's what the APY is, right? And so unless you have revenues, unless you're generating demand for the token, that APY is not sustainable. It's just inflation calling itself something else. So I think those are some of my, favorite quote unquote bad tokenomics, is those like 1,000% APY things that are just like massively inflationary.
So, yeah, I feel like crypto is unique in that regard, where we've seen what in TradFi would be 8-year cycles happen in the period of 4 months. You see a full
Yep.
Ponzi scheme go up, reach many billions of dollars in value market cap, and then immediately implode. And I guess from what you're saying and what you've seen is it's around a bad token structure. It's around these fake APYs from this inflation model that's sort of built in. I'm wondering if you could tell me a little bit more about that. Why do teams design tokens like this? And do we see it today?
Yeah, yeah. So I mean, I don't know if it's the cause of the issues, but or a symptom of, some of the conditions in the market. Like you have very short attention cycles, and you have, for whatever reason, you have people speculating, moving on to the next thing. And so a lot of founders, especially if they're struggling with product market fit, especially if they don't have, a product that really stands on its own, they view a token as like an easy button, right? Or like a magic solution, right? You just launch a token, you just, drive a bunch of emissions, you can reward people. And to be fair, if you do that well, it works for a time. But obviously, if there's no sustainable interest in the token, if there's no revenue, if there's no demand, if there's no, usage, no supply lockups, no utility, that can only get you so far. And so I think it's hard to blame that only on founders, given the market also is like very, short attention cycle and keeps, or at least kept falling for the same mistake so many times. I think people, to answer your second question, like have finally started wisening up and learning. You'll see people in this cycle, it feels like people, realize like, oh, I've got to actually take profits, and, a 1,000% APY is like too good to be true. So slowly but surely, people definitely have learned, um, and we are seeing some improvements to tokenomics, where more focus on buybacks, more focus on revenue accrual, on strong utility, and I think you'll see that continue. We'll see not even just crypto assets, but tokenized hard assets, tokenized real estate, treasuries, equity, right? That these things have like underlying things associated with them that the token references, whether that's literal ownership or some kind of cash flow, from that thing. So yeah, we're moving to a world slowly and painfully moving to a world where tokens are token and blockchains are a technology, and they're wrapping or representing hard assets that do have fundamental values driven by usage and cash flows, like old school companies, I would say.
So what what is tokenomics if you could break it down to its fundamentals? And
Yeah,
is this something unique to crypto and blockchain, or is this something that has existed before and it's really emerging more and more now?
that's a good question. I mean, tokenomics in my mind is the everything that goes into shaping kind of the incentive structure in your protocol. And so it's the things people generally think about, your emissions, your pie chart, your emissions chart, but it's also, all your incentive mechanisms. It's also everything you're optimizing of, like, who do we reward for what action? How much do we reward them for doing that? What can you do with the token? It's the utility, it's the life cycle, how are tokens burned? It's everything that goes into the flows of your token and the incentives in your ecosystem, that you've built. And so I think before blockchain, tokenomics, the closest thing that existed to tokenomics, I would say, is actually like in-game economies, like Web 2 games, right? Like, WoW, the World of Warcraft, its economy. Eve Online famously employs like a full-time PhD economist just to balance its in-game system. So I think that is like the right mental model. I think a lot of tokens, you can view them as in-game currencies. Like, that's actually the way I like to think about gas assets for Ethereum and Solana, for instance. Like ETH, Sol, Bitcoin is kind of its own thing, but these are in-game currencies for like using and playing, the ecosystem of ETH or Solana. And so I think those are like the closest comparables, where you can mint these things out of thin air because they're virtual, but you need to obviously balance that somewhat. Otherwise, you start to warp the balances in the system, and then it collapses to one endpoint, whether that's runaway inflation or runaway deflation, or just where all users stop using it, and it becomes hard to revive. So I think games would be kind of where tokenomics got started. I think Bitcoin is kind of its own thing, being like a hard form of money. But most tokens these days, they can go one of two routes, I would view. You can't really compete with Bitcoin or stable coins as money anymore. I think lots and lots of projects tried to and failed. I think realistically, projects you need to compete on, this is a token that improves in some way an existing product, right? And so whether that's in the case of Uniswap, for instance, right? Like Uniswap needs liquidity providers. If they have more liquidity, the product itself is better, right? Traders get less slippage, like everybody wins. And so the token can legitimately bootstrap out that liquidity, be used to drive those rewards, thus improving the product, generating more fees, and those fees can go to token holders. I mean, Uniswap is just now finally getting around to turning on the fee switch, but in theory, right, it is possible to design these tokens that benefit the system overall. And like that's increasingly where we're going. And when people say revenue meta, that's ultimately what they mean. That like tokens actually have a purpose, they benefit the system, and there's some demand and value behind them.
I've got to say, and I got to give my hats off to you. I feel like you're so deep in tokenomics, but I love it. I think tokenomics. No, seriously, I think it's the coolest thing ever. When it whenever I like, not only is it is it cool, but it's incentives. Like boiling it
Yep.
down to what you
Yep.
just said, it's incentives. And I think Charlie Munger has this quote which I love, and I'm fully gonna butcher, but it's like, show me the incentive and I'll show you the outcome.
Outcome. Exactly.
Yeah,
Yeah.
yeah, exactly.
Got it. Yeah.
And it's funny to me that like Charlie Munger hated crypto, but I think maybe he was just like a little bit old to see like, hey, actually, there's a new incentive system
Mhm.
that's being developed and being built, and you've really been on the forefront of this. I guess from what you were saying, we've seen it in gaming, but now it's being applied to more and more businesses.
Yeah.
So yeah, I guess I'm curious. what are some good projects who have done like a really good job of this where you've seen it really work?
Yeah, I mean, obviously the example on everyone's mind these days is Hyperliquid. I think that's an easy low hanging fruit one. But I think what's also very impressive is these projects that what I like to think of tokenomics is, again, this holistic system, all the parameters involved, all the moving pieces. Some people only think about like the native token, but I would argue things like Maker DAO's collateralization system and how it makes sure that like Maker the interaction of Maker supply and DAI and the collateralization of ETH of DAI so that I can redeem it for it's backed value, it's pegged value at any given time. That is all economic, I mean, obviously there's technology to implement that, but that design is all kind of an economic, a tokenomic design, right? A peg mechanism, liquidity to contain it, the economic trade-offs of Maker issuing more, Maker and auctioning off to re-collateralize the protocol. So I think long-standing DeFi projects, almost all of them, the ones that have survived, like it's a bit of maybe survivorship bias, but like they have done something right, right? Maker, I think, has done an excellent job with their token design. These tokenomics protocols that have thought carefully through all the incentives and covering kind of the bases, right? So if the protocol does experience unexpected kind of sell-offs and there is under collateralization, there's got to be a recovery mechanism to do that, and there's got to be an incentive for people to take on that risk of being diluted to collateralize the protocol, and so that's fees going to maker stakers, for instance, right? So some of the long time DeFi protocols have done it really well. I think GMX has done it really well, where their rewards for staking are actually what they call escrowed, meaning they're not immediately liquid, so you kind of have to convert them into something you dump. Which, if you think about it, makes the payoff structure to get to put a game theory lens on it, makes the payoff structure less attractive to someone who just wants to farm and immediately dump, but not really much less attractive. Doesn't really change it much for someone who would hold long term anyway. And so again, a couple of these big DeFi protocols out there have done it really well. Hype, of course, these days bringing back the revenue meta. But I think anybody that's generating a bunch of cash flow and driving that to the token has strong tokenomics.
Is that a security?
Yes, that is a great. I mean, not yes, but that is a great question. That is the question on everyone's mind, right? I would argue not necessarily. So I would argue that it could be a security, especially if it's fully discretionary and it's just people making these decisions and there's not really much transparency of investors of like what's getting in, and the core team is actually pulling all the strings manually and it's not like software driven. But if you think about like what's the purpose of these securities laws, right? Like take a step back, not just think about it from what we have today, but think about like why we have these rules and what they should be doing, even if they're not serving the purpose. I would argue, and I think most people share this opinion, that securities laws largely exist to protect investors from getting ripped off by insiders, right? It's basically around insider information that some employee, a CEO, isn't outright lying to you, isn't misleading you, isn't embezzling your funds. And so if that's the purpose of securities laws, to make sure that no one human being with insider information or information asymmetry is abusing the system and exploiting people, then they're kind of irrelevant in the context of an autonomously operating piece of software where everyone has public access to all the information available, right? And so if you have, think about a DeFi protocol like Curve, for instance, where it's a piece of code that's been deployed on a decentralized network. Anyone can see the code, anyone can see what it does, and it literally runs itself and it captures a fee from a user activity and it distributes that fee automatically to people who stake its native token. But no one is sitting there and like being like, oh, I'm going to, issue more Curve today to myself, even though I'm lying to people and saying it's not going to happen. And then I'm going to, decide to pay out a dividend, but only to my friends instead of all the token holders. Like there is no insider information. There is no information asymmetry. And so I would argue in those cases, they're not securities. There's this perhaps this new asset class, but it is fundamentally not the same thing as a share of a company that is run by a human being, right? That has like insider information that you don't. They're
Right.
two different things.
Yeah, I mean, it is interesting. It is totally different, and I don't think we legally, as a society, have a framework for this stuff yet.
Yeah.
I think one of the cool things about crypto in general is it's, I mean, yeah, not to be corny, but it's decentralized nature, right? The fact that
Yeah.
that anyone is able to access it, to read the code, and sort of have access to a market and access to financial freedom. If
100%.
if you look at like if you bought Hype, not financial advice, but if you bought Hype a year ago at this time, you're doing incredibly well now, and it's
Yep.
because it's a successful company. It's actually accruing revenue. It's using that revenue to buy back the token, and
Yep.
you have a really good structure. And I think one of the other cool things I want to hear your thoughts on is maybe tapping into Chris Dixon's read write own, which is the
Mm.
airdrops and incentivizing community and growth through tokens. Hype did a good job. Where do you see that role in tokenomics models?
Yeah, so I mean, I kind of alluded to it with the example of Uniswap, like tokens. One of their superpowers is coordinating user behavior, right? Again, all goes back to incentives, and so products that can successfully use their token to sustainably, keyword sustainably, incentivize certain user behaviors to bootstrap, activity. Those are the ones that succeed, right? And so if you can, you know, go from 0 to 1 by issuing a token and rewarding people who provide liquidity. And because there's liquidity, that kicks off natural trading activity. And now, because there's natural trading activity, there's fees, which brings in organic liquidity looking to earn those fees. You've kicked off this self-sustaining cycle by emitting the token in the first place. And now, if you're just emitting tokens blindly, and especially at like crazy inflation rates, like 1,000% APY, and you're rewarding the wrong behaviors, and the behaviors are not creating this organic, self-reinforcing cycle, this network effect, then those are the protocols that collapse, right? They just got hyperinflation and nothing to show for it.
Yeah.
But the projects that have done, and this is kind of what Chris is getting at, is like an airdrop isn't necessarily evil by itself, but it needs to go to rewarding the right people for performing the right role in the ecosystem so that the whole ecosystem grows. Now, that being said, I'll contradict myself a little bit and say I do actually think that airdrops are not the best mechanism. I think there are improvements over airdrops. One of the biggest weaknesses of airdrops is that you have people getting in with a literal zero cost basis, right? They don't pay anything; they get all this free stuff. And we know from psychology, from behavioral finance, from all sorts of like studies and empirical data that people treat things they get for free very differently than something they pay for and they acquire. They put skin in the game. And so my preferred approach to this is, rather than giving people a free airdrop, giving them access to buy into the project, maybe a discounted FDV, sale, but you could still run all these like points programs, for instance, and then they lead into a token sale instead of an airdrop. So people are putting their skin in the game, they're getting aligned, they're not getting a zero cost basis, but they're still getting a benefit and being rewarded for performing a certain activity in the ecosystem.
Fascinating. I feel like we're getting into Daniel Kahneman thinking fast and slow, and just
Yeah.
behavioral economics.
I mean, it all goes into it. That's one of the fun things about tokenomics, right? Is like it's so many different fields all combined. A lot of it is quantitative, but a lot of it is also just qualitative user behavior and psychology.
Man, okay. I have so many questions I want to ask you about this, and specifically on the psychology. But just
Yeah.
to wrap up sort of the last thread, what I'm hearing from you is that to a degree it's also about buy pressure, right? Like if you
Yep.
have a zero cost basis airdrop to a ton of people,
Hmm.
like they're just incentivized to sell this thing, and your
Yep.
your token's gonna free fall in value. If you hyperinflate and print a bunch of tokens to buy back your tokens, like it's just a disaster.
Yep.
Um, so is that what it boils down to? Is it creating like just real buy pressure on your token?
I will say, I mean, in general, tokenomics is all about balance, right? Like we talked about,
Mhm.
in the context of MakerDAO. you need to make sure that there's an equilibrium of like how much incentive you're paying for certain behaviors. If you pay too much, if you pay out too much, emissions, you have more inflation than necessary. If you pay too little, you're not getting the behavior you want. And nowhere do you see that most, or you see that most of all, I guess I should say, right at TGE, right, where it's very important to balance, as you mentioned, kind of supply pressure and demand pressure, because at TGE, that where your price, the token sells off, like wrongly or rightly, people are judging your project first and foremost on your price, right, on the price
Yeah.
performance, and your price crashing is pretty hard to recover from, right? So pulling off a good TGE is very much a balancing act of supply and demand pressure. And I think one of the interesting things that people don't realize when they think about it is your demand is largely fixed in USD terms, right? There's people, they want to buy your token, they're probably buying in stable coins. There's maybe some retail, like people are thinking about, okay, I'm gonna take X amount of money and put it in this stable coin, right? So your demand for your token is largely a function of USD. Of course, you get listed on different exchanges, that number goes up, but it's largely fixed in USD. Whereas your sell pressure is fixed in the number of tokens you're emitting. So all else equal, more tokens, higher valuation, right? You have more USD sell pressure. And so I think people oftentimes, don't balance those two things on equal terms. They just think about, oh, I'm only launching, 0.1% of my supply with this airdrop. But if you're doing like $1 billion FDV, that still eats up, more, a lot more of demand pressure than, the same percentage airdrop does at a lower valuation. So you really have to think about USD terms, equating the two, the supply and demand, which is a function of token unlocks, the function of who you're giving tokens to, a function of narrative, a function of the market makers you work with and the terms you're signing with them, a function of the exchanges you're getting listed on. So it's also a bunch of there's the token design element, but there's also just a ton of like how the sausage gets made kind of stuff in the background of negotiating exchange deals and market maker arrangements and all that sort of stuff as well.
Yeah, and honestly, I don't even want to know how the sausage is made.
I mean,
I've
it's
heard some horror
yeah,
stories.
yeah.
Like,
There's
this is
definitely
not
some
a regulated U.S. market. Like, this is.
no, no, yeah.
Um,
There's a
I,
lot. I
I
mean, these days it's in vogue to work with like quote unquote active market makers, which from a Western lens basically means like they're committing crime. Um, yeah, yeah,
well, one thing that I find super interesting, and a point that you made is how your coin performs, or how your token performs on TGE really does dictate how well the project does. Like, there
yeah,
is a virtuous flywheel of like, hey, your token's actually gone up in value, and now all these people are talking about your token, and you're getting so many more users to your actual platform, which drives real revenue, which drives the token price up.
yeah,
And it's this like beautiful virtuous thing versus you have I don't know, like uh, movement, right? You
yeah.
gotta try and rug pull, and then the whole ecosystem just disappears.
Yeah, yeah, I think it is tough. Obviously, there are cases people can think of that run counter examples where
Hmm.
good projects have recovered from their token selling off. It's by no means saying impossible.
Yeah.
Solana even did it, for instance, right? But it makes it much more difficult, right? Because obviously, you start to lose mind share, you start to lose attention. Like there's again going back to the psychology, like people selling and dumping creates other people selling and dumping because you have this kind of FOMO, right, effect, and like people giving up on the project. And then it's also harder because now each unit of your emission, each unit of your token that you're handing out is worth less in dollar terms, right, in terms that people actually use and spend. So ironically, to to get the same level of like user action, you need to emit even more. So it's this negative loop, right? Of like, okay, token goes down in price, I need to emit even more tokens just to make up for that fact, which causes the token price to go down even further. So it is very tough to recover from a botched token launch and your token price declining. And most of it again comes back to making sure that you've balanced buy pressure and sell pressure at that TGE.
So jumping back a little bit to the behavioral economics, what's the most surprising thing that you've learned about human nature from studying tokenomics?
Oh, that is a good question. What's the most surprising thing? I mean, I think you're seeing it somewhat change now, but one of the great things about crypto is just how much people are, one of the great and terrible things, I suppose, how much people are willing to, go and just like help out projects, for the promise of this crazy, like, I'm sure we all can think of people off the top of our head that are basically doing a full-time job for a project, and not getting paid for it, right? They're
Yeah.
doing it for the love of it. They're doing for the, the potential, like one day there might be an airdrop. So I think points programs have really shown this. And of course, there's fatigue that is setting in, but the like it's almost more effective before the token's launched, right? Like when I don't know the value of the points, and in theory I could be, a multimillionaire tomorrow from these things, like people are willing to do a lot more when they feel like they're getting rewarded, and they feel, and they can speculate, they can dream. It's like the sensation of buying a lottery ticket, right? Like you can almost treat the ticket as like an expense, so that you can, so that you can daydream, right? You go to the movies, you pay for your movie ticket, you buy your lottery ticket not to win money, but so you can daydream about, oh, okay, if I did win this money, here's what I would do with it. And I think that you see that same behavior basically in crypto. People, working their asses off for these projects, or doing a bunch of stuff they wouldn't otherwise do, or dreaming about what these points are going to be. And then ironically, once the token actually launches, a lot of that goes away. Um, but um, so yeah, I think that's the most surprising thing to me, is just like how powerful that is for people. And the challenge for projects is carrying that over. And a lot goes into it. You can design your points programs in stronger or weaker ways to reward like organic users to begin with who would carry over. But a lot of the challenge these days of launching a token is carrying over that momentum from the points program, and making sure that people don't just move on to the next shiny thing. But yeah, it's still kind of surprising to me of just how effective that shiny thing is and can be.
Wow. Yeah, that is super interesting. And I haven't really thought about it like in I guess the context of like a lottery or daydreaming,
Hmm.
where I mean you see it like I've done random stuff like
Sure.
quests and
Yeah,
stuff,
yeah, yeah,
like,
yeah.
oh
And
yeah,
oh,
I'll get
this could be something, like, yeah.
yeah,
It's
yeah,
almost, yeah.
exactly.
Before, it's almost like a mystery box, right? Like before it's
Yeah.
unwrapped, it could be anything. So yeah. I mean,
Yeah.
obviously there's types of people where that's not appealing, but you already, like, crypto, is skewed to like massive risk taking type of audience. And like among that audience, right? Like, sure, I'd rather have the mystery box. Like, yeah, let's go.
Yeah, man, that's super interesting. Uh, so I guess we'll jump to a question that I have wanted to ask you. And did Satoshi nail it? So
Mm,
Bitcoin, right? You get the halvening. You have a
yep.
pretty interesting token design. Did
Yep.
Satoshi just get this thing perfectly right, and that's why we have this massive multi-trillion-dollar market cap, or what's going on?
I mean, hats off to Satoshi. Obviously, he's a much smarter guy than I am. I can't, you know, criticize anything he did, but I would just, like, let's evaluate that statement, on a like a probabilistic phase, right? Like, how likely is it that the first ever cryptocurrency essentially was designed perfectly? He saw ahead in advance and foresaw every possible challenge, everything that could go wrong. Seems unlikely, right? And I think if there is a weakness, you can point to the reward system, the fact there's no tail emissions, for instance, right? At some point, it will become, the incentives are kind of eroding to mine the chain, and that kind of starts to put at risk people being able to do, shallow reorgs at first, but do reorgs and double spends and all the kind of nasty stuff that you don't want to happen. And that has a major threat, because even if that just starts happening occasionally, or very rarely, it erodes the trust in the use case of the system. And so it starts to chip away at that, which makes less mining and, which makes overall mining less profitable, assuming electricity rates stay the same because the price per Bitcoin would decline. So it can risk causing this, this runaway feedback loop that collapses the system. Of course, I'm not saying that's guaranteed to happen. Satoshi's much smarter than I am, but if there is a weakness, I would have to think that it is around kind of the long term, um, you know, security budget, if you will, for Bitcoin. And again, trying to think of this more just objectively, is it likely that someone could design a system that works for a year? Sure. That works for 10 years? Yes. That works for 100 years or 1,000 years? It's increasingly less likely that just like the first design worked perfectly and it needs zero changes whatsoever.
Matty, I hate to be the one to tell you this, but so this came from aliens. This isn't an individual. This
All
was
right.
this
Well,
was
yeah, maybe
put,
it was a
this
time
put
traveler,
on.
or an alien, yeah,
Yeah,
or a quantum computer AI that
yeah,
came
from the
back. Yeah,
future. Yeah,
yeah,
yeah.
exactly. In that case, then yeah, he's got it perfect. Yeah.
No, it is interesting, and I think in the immediate concrete is we need fee revenue to
Yep.
start taking over the inherent block rewards. And there's almost a, I mean, this will be interesting to see how it plays out, but there's like a disincentive for anyone to transact Bitcoin at all, because why would you buy a coffee for Bitcoin if you think this thing's gonna 10x? Like
Yeah.
why would I ever use it? Um,
Yeah. This is the
so
challenge. I mean, this is the challenge of a deflationary like currency, right?
yeah,
Like why spend it today because it's going to be more valuable tomorrow. And so you can see in economics, in Japan, for instance, they've had this problem of, deflation can be really, really nasty. In some ways, even worse than inflation, because you just have like no one starts spending. The system collapses because no one's spending the money is literally worth more tomorrow. So why spend it today? There's no consumer spending. There's no growth in the economy, which leads to further deflation. So um, this has always been the risk, actually. Like I kind of mid-curved Bitcoin initially and didn't buy in, super early when I first heard of it, because I thought like, well, that doesn't make any sense. How can you have, a cash system that is deflationary? That being said, of course, there's a long way for it to go before that actually becomes the major, the tangible problem, which was the point I mid-curved back in the day. But I think that eventually Bitcoin has to figure that out at some point. And you're already seeing that, like the original white paper clearly intended Bitcoin to be more of a cash replacement, right? More used
yeah,
for payments, but the emergent behavior of the system is not that it's used for payments; it's used for storing value, right? And so storing value, sure, you can be deflationary, but the security mechanism is built on the premise that the system does operate as a payments system. And so I think that's why another reason I think like if there's a weakness, it's the security system and like the security budget. We need to revisit that in some way. That's also why I'm a fan of Bitcoin L2s, because Bitcoin L2s that have their own token emissions can effectively act as a tail emission for Bitcoin without modifying Bitcoin itself, right? So
yeah.
I think you have maxis. I mean, maxis finally seem to have died off, a year or two ago, or way less aggressive than they used to be. But I think we'll see another wave of that, of people realizing like, okay, we have two choices realistically, or three choices. We can let Bitcoin fail. We can change Bitcoin itself. Both those suck. Or we can bring in, Bitcoin L2s, systems that kind of extend Bitcoin. They have their own token. Yes, it's inflationary, but that's kind of the point. It acts as this pseudo inflation for Bitcoin without modifying Bitcoin itself.
Yeah. Man, it's so interesting. Like, I mean, just how it's developed over the last decade. I was listening to a podcast recently, not to
Hmm.
get meta, podcast within a podcast, but listening to a podcast. It was Tim
Your own.
Ferriss, uh, Tim Ferriss, and the CEO of Roblox. And
Okay.
Roblox, they have Robux. Have you heard of that before?
I've heard of it. I'm not super familiar. Yeah.
So it's an in-game digital currency, and I think they like had this before tokenomics was taking off. It was like a pretty early thing. And
Yeah.
one thing he mentioned is that you just have no idea like what's gonna happen. Like you launch these things out there with their incentive mechanisms, and then
Yeah.
it just like takes on a mind of its own.
Yeah. I mean, the emergent behavior, right, is a term I use. Like the systems can lead to user behaviors or outcomes that were never intended that just kind of naturally arise. And I think games are a great example to study for this. There's a really great book. I think it's Virtual Economies, like design, like the game. Just, I think it's called Virtual Economies. Subtitle like design, economic design for games or something like that. But it has just a bunch of examples and case studies. Like I think it was like RuneScape, where there was a currency, but it was so inflationary that people ended up using like horse poop, horse dung objects that you find in the game because those were scarce and rare, and so that turned into the actual currency that most people transacted in. Yeah, like
Oh
pretty
boy.
pretty strange. Yeah. Um, Behaviors that come out. There's another great example of like early um, app in early kind of like yeah, mobile app in China where you could earn some kind of points in the game, and you could buy like digital like skins and things for your avatars and things, and it just became so popular that literal like stores started accepting these points for real goods and certain like it became effectively a currency within, and so the Chinese government was like, no, we got to shut this down because it's competing with the yuan. We want to control our currency. So yeah, I mean there's things you can't foresee happening. um but yeah, there's some great examples, and I think again games and these early kind of like meta what's the word, the like a game, but you can't believe I'm blanking on it. Where the metaverse.
Yeah,
Like,
there we go.
like these early kind of metaverse attempts and games like have some of the best examples of these emergent behaviors.
I knew what you were going for there, but I just had to let you let you.
Thank you. Yes, thank you so much.
So okay, it's 2025,
Yep.
and guess what? We're launching Matty Coin. Uh,
Uh-oh.
so Matty, how are you? How would you go about designing this coin?
I mean, it's got to start first and foremost with a product that it's backing up, right? Like, so I need a problem I'm solving for people. I need a solution or a tool that people are using to solve that, and then this token has to play an organic role in that product, right? It's got to, if you have this token, you get premium access, or you get faster speed or cheaper access, some kind of feature within the system. And then I'm thinking very carefully about who I'm emitting tokens to, what behaviors I'm rewarding, mapping out the incentive structure, the behaviors I want to reward, the behaviors I want to disincentivize, quantitatively modeling out how do I optimize those parameters. So, for example, sometimes you'll have conflicting things like, again, in the case of Uniswap, because it's the simple thing for people to understand. Obviously, increasing the fees that are collected on a trade is great for LPs to provide more liquidity, which you want, but you also want more trading behavior, and increasing the fees reduces trading behavior, all else equal. So you have this direct conflict of incentives, and so the only way to really do that is to quantitatively model out where is the optimal point of a fee that generates the most trading activity overall, which is going to be a function of how much liquidity is there and how much trading activity is there. And so I'm thinking through these incentive structures. I'm finding the conflicts. I'm quantitatively modeling out to optimize the variables and the parameters that plug into the system. I'm negotiating very toughly with market makers and not doing loan option models by and large. I'm doing retainer models for market making. I'm working with the exchanges, working with distribution on research reports to make sure that people understand the protocol, that there's liquid funds that are going to be buying the token after TGE, right, on the open market. So all of this goes into a successful token launch, and that's kind of the super quick high level playbook that I'd be applying.
Yeah, needless to say, when I launch Matty Token, I'm going to you first to
Yeah,
make sure
please
that
don't
we
launch Matty Token without me. That's for
yeah,
sure.
yeah, yeah, yeah.
Uh,
Is there a way to like to test these things? I know you said model it out. Is that just like
yep.
an Excel model, or is there a way to sort of get some like real live feedback before you blast these token models out to the world?
Yeah, I mean, I think you can learn from other people's mistakes, right? You can look at
Mhm.
like real world data of what have similar protocols done, and and in some cases, I mean, I think there's two things. There's simulations you can run on more like automatic rules, right? So like if you have a collateral or a loan type of like mechanism in your protocol, you can run simulations and say, if this happens, this is expected to happen, and so we need to tweak the options so that when this expected thing happens, the whole system doesn't collapse. Then there's a different thing, which is user or like human behavior, which you can simulate to some extent, but ultimately you have to more or less run experiments and like test, right? Like, do people actually behave the way I would expect them to behave? You can't just like plug numbers into a computer and simulate it without inherently making assumptions about how people will respond, right? So I think you kind of have to identify like what is it that you're actually modeling out, what factors you actually constrained by. So what are we trying to operate, within? What are we trying to optimize for? So are we trying to maximize trading volumes? Are we trying to maximize revenues? Or are we trying to minimize inflation, right? Too many people just like delve into like going through, their tokenomics and plugging in all these numbers without even actually first understanding like what they're doing and why they're doing this. Like, what are they trying to get out of it? So yeah, I'm thinking carefully about all those aspects, the things we actually need to test. And then yeah, Excel can work, Python can work. I'm a big fan of the tool Forged. It's a free tool for teams out there where it helps you with everything about tokenomics. So plan out your tokenomics, model out the kind of, what worked for other projects that were similar, looking at supply schedules, what kind of demand boost can you expect if you get listed on this exchange versus that exchange? What kind of sell pressure can you expect? Helps you, contact the right market makers and lock in the best terms. So I always am a fan of Forged as a tool. But then, not every founder can or should spend all their time doing this themselves. And so I think it also makes sense to work with an expert who has seen multiple launches, and maybe they're also using a tool like Forge with you. But founders, by and large, I think it's a mistake to, unless you're like a repeat founder, you've done a successful token launch before. It's wise to work with someone who has seen many different token launches and knows what to watch out for.
Yeah, and it is so important. Just circling back to the beginning of the conversation, having a successful token launch can make or break the protocol, right? Like price appreciation really does drive users, which drives off the whole flywheel. So uh, it's worth spending so much time considering this and getting this right because it can build your company.
Yeah, for sure.
So I guess just we're coming up on time here, so I wanted to say for the people that are listening, where should they go if they ultimately want to start diving a little bit deeper, or if they want to learn more about tokenomics or any of the other topics we were chatting through?
Yeah, for sure. So, I mean, you can find my X handle, which is just Matty underscore, Matty underscore, simplified it. And yeah, if you find it there, I think I have my link tree up there. But I have a free open source guide actually called Tokenomics for Builders. It's a as I said, open source, public good. It's got reviews from people like Keone, founder of Monad, Chris Berninski from Placeholder, Ilmoy from Tensor. So a pretty good reception of, making sure you're on the right track to designing your token in a common sense way. So I always recommend people start there. A tool like Forged, I recommend people start with. And then yeah, if you're curious about this topic, if you're looking at launching a project yourself, always happy to chat with founders. So Matty, Matty underscore on X, or Matty Tokenomics on Telegram. People are welcome to hit me up.
Awesome. And all right, I got one more for you.
Sure, sure.
Matty, you're smart. You're an interesting guy. Uh, outside of crypto,
Yeah.
what what is a favorite book of yours, or what's something that you've just genuinely found interesting that you think someone else should check out?
So I highly recommend this virtual economics book, but I know that's still in the realm. Um, yeah, I think recently read some really great fantasy. If you're a fan, a book called The Name of the Wind. I
Okay.
caveat recommending this because the author has finished two of the three books of this planned trilogy, and it's been like 10 years since he finished the third one. But
Game
the
of
first two,
Thrones.
yeah, another. But the first two, with the first one is called Name of the Wind, is some of the best some of the best fantasy world building and writing I've ever read. So if you're a reader, I would highly recommend it.
Awesome. All right, I'll check it out. Well, Maddie, thank you. Appreciate your time. Everyone, check out everything Maddie's ever written and published on the internet. You're fiscally incentivized to do so, but it's really awesome, and it's the beginning of a new economy. So check it out, learn more, and yeah, don't hesitate to reach out to me or Maddie on Twitter or wherever you can find them.
Awesome.
Cool.
Well, thanks for having me, Davis. Cheers.
Thanks.